Hello everyone, welcome back. We are solving accounting papers. This is 2025 May June. So we are doing paper 11 1. Question number 1. What are disadvantages of operating as partnership compared to operating as sole trader? So in partnership, first disadvantage they mentioned out here is partners may be liable for the actions of another partners. This is absolutely correct because if one partner makes incorrect choices or decision, then all other partner also has to suffer the loss that partnership makes. So this is one of the disadvantage. Next, profit have to be shared between partners. Yes, we know that in partnership we need to share profit, whereas in sole trader he or she takes entire profit from business. And third one, there is a risk of dispute between partners. Yes. So if there are partners, then there could be dispute between or among partners compared to sole trader where he or she is the only decision maker. So your correct answer is all three are the disadvantage. So 1, 2, 3. Correct answer is A. Let's move on to the next question. A business has falling balances at the end of the financial period. Non-current assets 102,000, trade receivable 39,000, trade payable 27,000, profit for the period 65,000, drawings 32,000, and long-term loan 50,000. So they have given assets, liabilities, and profit and drawings. Then they're asking you to calculate what is the closing balance of the owner's capital account at the end of the financial period. Okay. So now we need to understand the composition of capital account. So if you remember, capital account is prepared. Capital is assets minus liabilities. Okay. Now, if you have the balances of assets and liabilities in the beginning of the year, then you get the capital of the beginning of the year. Okay. And once we get the capital of the beginning of the year, and in that, to find out the capital at the end of the year, we need to do adjustment for profit and drawings. But whereas in this question, they mentioned that these are the balances at the end of the year. That means the assets and when we subtract assets and liabilities, the amount that we get is the closing capital account. That means we don't need to do anything with the profit or the drawings out here. Okay. So this is the closing capital balance we have. We have assets. So here assets that we have is 102,000. Another asset we have is 39,000. Okay, and then trade payable is liability. So I'll just write down the liabilities here. Liabilities 27,000. And the profit we don't take it, drawings we don't take it, long-term loan is also a liability, so 50,000. So these are my total assets. And in this total asset, we subtract total liabilities. So assets minus liability will give you capital. So our capital is 109,000. Sorry. Not 50,000. 64,000. So our capital is 64,000 out here. This is our correct answer. So 64,000 is option B. Okay. Number 3. A sole trader used the double entry system to record their business transactions. Which transaction does not follow the double entry rule? So if you remember, double entry rule is one account needs to be recorded on the debit side and another one on the credit side. First one, it says an expense account is debited at the end of the year when there is an expense prepaid on that date. Okay, so here we record the transaction and it is recorded on the debit side, but this is the amount that we paid for the next year, okay, prepaid. So this is actually does not follow the double entry system out here, because as per the double entry system we need to record transaction as per the accrual basis, okay, especially when we prepare the final account. Number B, a capital account is credited when a sole trader introduced their personal computer to business. Yes. So owner is introducing personal computer. So this is the additional capital. Capital account is credited and ultimately personal computer or the asset account will be debited. Number C, the provision for the motor vehicle depreciation account is debited when the motor vehicle is sold. Yes, when we create depreciation, the depreciation balance is credit balance. And when we are selling the assets, the depreciation accumulated for that same asset needs to be cleared. So it needs to be debited. So this is the correct entry for that. And number D, the purchase account is credited when a sole trader draws goods from the business. So if some owner is taking goods from the business, then goods would be taken at a cost price and that would be my purchase price. So it needs to be debited in my, credited in my purchase account and debited in my capital account. So right answer out here is number A, because this expense which we debited is not for this year, it is for next year. So it should not be recorded in my expense account. Okay, and if you remember, when we prepare the final account, the prepaid expenses would be subtracted and accrued expenses needs to be added. So correct answer is 3A. Number 4, a business owns a property which is rented out to tenant. Which of the following costs should be treated as capital expenditure? A capital expenditure is a long-term expenditure, one-time expenditure, not a recurring expenditure. So number A, extending the kitchen area, definitely a capital expenditure because we are extending kitchen for a long term. A legal fee for a 5 years tenancy agreement. So we are paying legal fee for 5 years. So this is a recurring expense. Every year we need to pay. Here we are doing it for 5 years. Okay, but normally agreement happens for 11 months or 1 year. So we need to do it on a yearly basis. Maybe they are paying all that at once for 5 years, but these are the recurring in nature. After 5 years, we need to do it again. Then repainting of the property. So this is the repairs. So repairs can be like mostly happens every year. So this is a part of recurring expenses. And last one is replacing a water pipe, that is also part of repairs. So all this legal fee, repainting, repairs, these are my revenue expenditure, recurring expenses. And extension of the kitchen is a long-term expense, so this is the capital expenditure. So your correct answer for 4 is A. Number 5, which statements describe factors that may cause a non-current asset to depreciate? So question is why asset depreciates? And if you remember the causes of depreciation, there are 4 basic causes of depreciation. Let's see if we have them in the list. Number 1, a reduction in the estimated useful value of the non-current asset. Definitely not. Number 2, the introduction of new technology making the non-current asset obsolete. Yes, this is one of the causes of depreciation because asset value decreases when the new technology comes up. Number 3, a change in the estimated useful life of non-current assets. Okay, definitely not. Here there's just the useful life of the asset is decreasing from 5 years to 10 years or 10 years to 5 years. Okay, so and then the 4th one is physical deterioration due to increase in the use of non-current asset. Yes, when we use the asset would deteriorate and we call that wear and tear. So that is one of the causes of depreciation. So there is obsolescence and deterioration or physical wear and tear is there. So these are the two causes. So right answer for 5 is 2 and 4. So 2 and 4 D only. Apart from these two causes, there are other two causes like passes of time and then depletion. If you use the natural resources and you extract natural resources, the value of the asset will go down slowly. Number 6. A business purchases a non-current asset which had an estimated life of 10 years. It is depreciated using the straight line method. So useful life is 10 years and depreciation is a straight line method that we are following. At the date of sales, 5-year depreciation has been charged. So we are selling this asset. We already charged 5 years depreciation on this asset. The following information is available. Original purchase price 100,000. Estimated residual value when purchased 20,000. Selling cost 8,000 and loss on sales is 10,000. So question is, what were the sales proceed? Okay, let's do some calculations out here. So cost is given to us and that is 100,000. And then they also gave us the residual value. Okay. Now if I want to calculate my depreciation, let me do it here. Then the depreciation formula is cost minus scrap value, and then this would be divided by useful life. Now in this question, the cost is given 100,000, scrap value was 20,000. So 100,000 minus 20,000, 80,000 divided by useful life, which is 10. So the depreciation supposed to be 8,000 per year. And they say that we already calculated depreciation for 5 years. So the accumulated depreciation is 8,000 into 5 years. So that is 40,000. So 40,000 is my accumulated depreciation on this asset. So on this date, the net book value of the asset is 60,000. Okay, very simple. Now, in normal case, we find out how much we are selling it for to calculate the loss. Okay, so we don't know what is that amount, but we know how much loss we incurred in this. So that means loss on disposal is 10,000. That means most probably we sold this asset for 50,000. Net book value of the asset is 60,000. If we sold this asset for 50,000, then we make a loss of 10,000, correct? Okay, but this is not the amount because they said that there is sales cost as well. So we did not sell it for 50,000. We must have sold it for more than 50,000. That means this 8,000 was also part of my sales proceed. Okay, so total sales proceed that we have is, this is the cost of sales. Sales proceed should have been 58,000, and let me explain this number. So if sales proceed was 58,000, out of this 8,000 was given to as a sales cost. Now we are left with 50,000, and they are saying that we made a loss of 10,000. And when we add 10,000 to 50,000, we get to the net book value out here. Okay, so the sales proceed out here is 58,000. Our correct option is C. So question number 6, C. Question number 7. A business maintains control account as a part of its double entry system. Which error would have caused an entry in suspense account? Okay, so we are maintaining the double entry system and there is an error which would create an suspense account. Suspense account basically means either the debit side or the credit side in the entry is missing. And when we prepare trial balance does not match. We need to create suspense account to tally trial balance. So option A purchase journal total 9,870 is incorrectly posted as 9,780. Now remember, this is the journal that we have made, and journal would be posted into the ledger account, and this total of the journal will be created in the control account. So this is only incorrectly posted from the total to control account and not to the ledger account. So basically all the ledger account balances are correctly entered. So this is not the error. Number B. Carriage outward is credited to carriage outward account but correctly accounted for the cash book. Okay, so when we pay carriage outward, it is an expense, so it should be debited, but we wrote it on the credit side. And we paid for this carriage, so we will write it in our cash book. So basically it is on the credit side, and they say that it correctly entered in the cash book. So that means the carriage inward should have been on the debit side, we wrote it on the credit side, and this could have caused the difference in trial balance and the creation of suspense account. So your correct answer is for 7B. Number 8. Which item is not likely to be updated in the cash book when preparing the bank reconciliation statement? So if you remember, when we prepare the bank reconciliation statement, we do it in 2 stages. First, we update our cash book. We'll compare the cash book and the bank statement. Whatever entry is not recorded in the cash book from the bank statement, we record them. Okay, that is updating the cash book. And second stage, we prepare the reconciliation statement, in which we write those entry which is not recorded in the bank statement from the cash book. Okay, so here they are asking you, when you update cash book, which entry will you not write? First one, direct debit. So direct debit means it was directly debited from my account. So bank is saying that I had to pay some amount and it was directly debited from my account. So now I found out about it, I need to update it in my cash book. Second one, dishonored check. I deposited check in the bank, and bank, after verifying, they are saying that the check is dishonored. So now we need to update that, saying that we have not received this money, and then ask this trade receivable to pay us again. Next one, standing order. So I gave instruction to the bank that on this particular day, pay this much amount to so and so. So now this order is executed by the bank. So I now have the update of that. So I also record that in my cash book. And last one is unpresented check. So I issued check, the receiver of the check has not gone to bank to collect their money. Okay, but they will go in the future. Maybe they are taking some time, but will go in the future to collect that money. So this is already recorded in the cash book, so I will not record this to update my cash book. Okay, so your correct option for question 8 is D. Number 9, a draft statement of financial position shown in bank balance of $1,400. The following information is now available. So there is a draft statement in for the bank in the financial position, which is 1,400, and these are the information that was given to us. One is check issued but not yet cleared by the bank. So I have issued a check, but bank hasn't cleared that check yet. And then bank charges not in the bank cash book. So there's a bank charges we are paying, but it's not recorded in the cash book. And the lodgement in cash book, but not on the bank statement. Lodgement basically means deposits. So we are depositing money in the cash from the cash book to the bank, but it is not reflected in the bank statement. So which figure is shown on the bank statement? Okay, so what should be the figure in the bank statement? We need to find out that. Let's say 1400 here. The first entry says that check issued but not yet credited by the bank. So we have issued this check from our cash book, but bank doesn't know about it. Okay, so bank still says that I have this money in my bank account, so I will add 150 out here. Second one is bank charge not in the cash book. So this is the amount as per the cash book, but bank says that I already subtracted 45 from your account, so we will also subtract that from our account. Okay, and then the last one is lodgement in the cash book but not in the bank statement. Basically deposited, and bank doesn't know about this deposit as well, because this 1400 is after the deposit of 220 and bank doesn't know. So bank says that I have not received this money, so I'm not going to add it in my account. So let's see what will be our total amount out here. So 1285. Option A is our correct answer for question number 9. And the last question for today, question 10. Which item should be recorded as debit entry in the sales ledger control account? Now, if you remember, sales ledger control account is prepared to verify all trade receivable balance are correctly recorded or not. Trade receivable basically means your trade debtors or asset. So if they are increasing, we write it on the debit side. If they are decreasing, we write it on the credit side. Okay, so out of this entry, which one is the debit entry? We need to identify that. Which one increases my trade receivable balance? First one, A, contra entry between the sales ledger and purchase ledger. So contra entry decreases the balance both in sales ledger and purchase ledger, because it is an entry for a customer being your supplier as well. Number B, interest charge on overdue customer's account. So now there's a customer whose account is overdue, so we are charging him or her interest on that. So this will increase the balance on trade receivable. So this will be the debit entry in sales ledger control account. Your correct answer for 10 is B. Let's look at other option as well, but C, irrecoverable debt written off. So irrecoverable debt written off basically means that now your customer won't be able to pay and you are writing it off their amount. So basically decreasing the amount on the credit side. And the total sales return is also on the credit side. So only one entry, which is B. So correct answer for 10 is B. Question says, some errors were made when preparing a purchase ledger control account. The incorrect balance was 15,830. The following errors were discovered. Refund of 270 from credit supplier had been omitted from the control account. Number 2, the total of the discount received of 480 had been posted to the wrong side of control account. So we need to find out what is the correct balance in control account. Okay, so for that, let's prepare a control account here, a mini version of control account, just to show you that. So if we prepare a control account here, and let's say control account is a credit balance. So it has 15,830 in the control account on the credit side. What does it say is, first one is there's a refund of 270 from credit supplier. So when we pay credit supplier, we'll write it on the debit side because it will decrease my trade receivables, so trade payable balance. Okay, so when we pay payment, we'll write down amount here. But now what we are saying is, from this payment, supplier is giving us a refund, okay, of 270. So we need to decrease this amount, so we'll write it out here, refund of 270. Number 2, the total discount received of 840 had been posted on the wrong side of control account. So when we receive discount, we write it here, and we supposed to write this amount on the credit side, the debit side, but we wrote it on the wrong side. That means we wrote this amount on this side, which is 480. We wrote it here, but now this is incorrect amount. So what we need to do is we need to correct this. So we need to remove this from here and then write this amount on this side. So in order to do that, what I'll do is I will write this amount 480 on this side plus another 480. Okay, so first 480 is to cancel this amount that I have written out here on the debit side, sorry, on the credit side, and another 480 is to write the amount on the debit side. Okay, so this 960. So on the debit side, total is this much, and the credit side total is 960. So let's find out the difference. So difference is this total minus this, and 15,140 is my correct balance. So option C is our correct answer for question number 11. Question 12. A draft profit for the year of a business 84,000. The following errors were then discovered. 1. Discount received of 2,500 had been debited to discount allowed account. Then wages of 9,000 had been completely omitted, and the sales return of 8,000 had been debited to the purchase return account. Okay, so there are 3 errors. Let's understand one by one. So we made a draft profit of 84,000. So let's just create that here. Okay, so we made profit, and that is 84,000. Now the first error is there's a discount received of 2,500. Discount received means income, and income is a credit balance, but we wrote it on the debit side, okay, of the discount allowed. So discount allowed is an expense and is a debit balance. So instead of writing it in income, we wrote it in expense. So all we need to do is we need to take out from expense and put it in income. So if we take it out from expense, which is the discount allowed, my profit will increase, and then when we put it back into the discount received account, my profit will increase again. Okay, decrease in discount allowed, which is 2,500 added to the profit, and increase in discount received 2,500, so it is also added into income. Then number 2, the wages of 9,000 has been completely omitted. So wages is an expense, so when we write expense, my profit decreases. So this is minus 9,000. And then the last one, here it says a sales return of 8,000. A sales return basically means expense. Sales is an income, sales return is an expense. Okay, so there's a expense of 8,000 which is supposed to be here, but we wrote that in the purchase return account but on the debit side. Now purchase return is your income, because purchase is your expense, purchase return is your income, and income, as I already told you, has a credit balance, but we wrote it on the debit side. That means my income is decreasing here, and so my expense is also decreasing by 8,000. So if I correct this amount, then my income will increase and my expense will also increase, so they will cancel out each other. So this particular entry has no effect on my overall profit. So my remaining amount is this much. So 80,000 is my correct profit for the year. Option D. For question number 12, option D is our correct answer. Number 13, which item would increase the profit for the year? Number 1, increase in allowance for irrecoverable debt, decrease in allowance for irrecoverable debt, increase in prepaid rent expense, and decrease in prepaid rent expense. So allowance for irrecoverable debt, if it increases, then we need to add more amount to it. Let's say last year we kept aside 2,000 rupees as an allowance for irrecoverable debt. Now that amount is increasing from 2,000 to 2,500 rupees. So this year we need to add more 500 there as an allowance for irrecoverable debt. So this will decrease my profit. It is a charge against profit. I deduct it from my profit. Okay. Whereas if the allowance for irrecoverable debt is decreasing, so last year we kept 2,000 as allowance. Now this year it is only 1,800. That means I can take out that 200 from those 2,000 and keep it as my income for this year. So it will increase my profit. So first option is option 2, increase in prepaid rent expense. Okay. For this, let's look at one example out here. Let's say this is the start of the year, January, and this is the end of the year, December. Okay. And January means last year's prepaid would be carry forward this year, and December means this year prepaid carry forward next year. So let's say last year prepaid rent is 500 and this year prepaid rent is 600. Okay. And overall total rent I paid this year is, let's say, 1,000. Okay. So when I calculate my total rent for this year, I would say last year I already paid 500 for this year. So this last year's prepaid is my this year's expense. And this year I also paid 1,000. So this is another expense for me. But out of this 1,000, 600 is paid for next year. So I'm subtracting 600. Okay. So overall my expense out here is only 900. Okay. So that means my expenses will decrease. If this amount increases, I know this is not the question for that, but just to make this question easy, if this amount increases, prepaid rent increases from 600 to, let's say, 800. Okay, so in that case, my overall expense in form of rent will decrease. Do you see that? It was 900, now 700. So because it will decrease my expense, my profit will increase. When a prepaid rent increases, my profit increases. Okay, because we paid expense in advance, and when we subtract that from the expense, overall expense will decrease. So your correct answer for question number 13 is C, 2 and 3. Question 14. Sam was unable to conduct a physical count of inventory at 31st December 2024. On 3rd January 2025, inventory was sold to Abdul for 11,950. The cost of the inventory was 9,560. Okay, so he could not conduct the physical count of the inventory on 31st December, but on 3rd January he sold some inventory. Forget about the selling price. The cost of those inventory was 9,560. Okay, taken out from the closing inventory of last year. And then on 4th January 2025, inventory was returned by Sita. It had been sold on 21st December 2024. So last year in 2024, we sold this to Sita, and now she is returning it on 4th January. And the amount is 2,390, but the value or the cost of the inventory was 1,912. Okay, but when we look at this on December, we would not know whether Sita would accept or return the sales. Okay, so on that day we still consider that we sold these goods to Sita, and that inventory is not with me. Okay, Sita is only returning that on 4th. So if we take this into consideration, then we can calculate what will be the value of the inventory. On 31st December, the value of the inventory we don't know, that is amount X. Okay, and then on 3rd January we sold. So sold, and this value is 9,560. Okay, and then on 4th, Sita returned product. So this is, and then returned amount is 1,912. Okay, so after all this, value of inventory on 5th January is calculated as 59,750. Okay, so now let's go in a reverse process. Okay, so this is the value that we have after these two transactions, but we would not know that Sita would return the product, so we'll still consider this as sales, and this cost of inventory is not with me and is with Sita. Okay, and these sales that happened after 31st December, so on this day I would not know that I would make a sale on 3rd for 9,560. Okay, so I'll add it back to my inventory. So this will be the amount of inventory that we have at 31st, at the end of the year, 31st December, 67,398, option C. For question number 14, your correct answer is C, 67,398. 15. Why does a sole trader account for accrued income? Accrued income is the income that we already earned, but we have not received the payment yet. So that means when we calculated my total income, I should include it as my income even though I have not physically received money, and that is as per the matching concept or accrual basis. So why does we do that? So that the profit is not understated. Okay, because this is the income I already earned, I should be including that. So your correct answer for 15 is D. 16. The following information is available for a sole trader's business at the end of the financial year. Cost of sales 540,000, expenses 325,000, profit for the year 63,000, and then the sales return is 30,000. What was the total sales figure for the year? Okay, this is very easy. Let me just put it in the format so that it's easy for you to understand what is happening in this question. So normally we write sales and we don't know that amount yet, okay, and then in this we subtract return, and then this return amount is 30,000. Okay, we subtract it from there, and once we get the net sales, in that net sales we subtract less cost of sales, and cost of sales out here is 540,000, so minus 540,000, and once we subtract cost of sales we'll get gross profit, that also we don't know, and once we find gross profit we need to subtract less expenses, and this expenses is 325,000. Okay, after we find all this we get profit for the year. Okay, now the question, profit for the year, let me write down the amount, 63,000. Now the question is we need to go reverse. Okay, if I want to find out the gross profit, I will simply add expenses to find out the gross profit out here. Okay, let's do that. Okay, I'm putting minus because minus into minus is plus. So this should be my gross profit. So in this gross profit, if I subtract 325,000 as my expense, then I will get my profit for the year. So we just found gross profit out here. And then cost of sales is subtracted from the net sales. Okay, I forgot to do that part. Net sales part. So net sales part we don't know. So cost of sales is subtracted from the net sales to find out the gross profit. We'll do exactly same thing what we did just now. So this is my gross profit, and in this we add the cost of sales. So the net sales on this date was 928,000, and when we subtracted cost of sales from there we got a gross profit of 388,000, and when we subtracted 325,000 from there we got profit for the year. Okay, now we need to find out the sales. So sales amount was net sales, and then in that we add the return, okay, which is 30,000. So my my total sales for the year is 558,000. When we subtract sales return, I'll get net sales. When we subtract cost of sales, I'll get gross profit, and when we subtract expenses from gross profit, I'll get profit for the year. Okay, so I'm doing this on a reverse process, which is 958,000 is my sales. Okay, so your correct answer is 958,000, which is option D. So for question number 16 is D. Now let's go to next one. A partnership maintains both capital and current account for its partners. Which is the correct accounting entry for recording interest on capital for partner X? So here capital account and current account is maintained so that the capital amount remain fixed. This is called fixed capital method. Okay, now all the appropriation of the profit would be recorded in my current account. Drawings, interest on drawings, and all the appropriation profit like interest, salary, then share of profit, everything will be recorded in my current account. Okay, so we can say our current account is another form of capital account. So if it is a capital account, then this also has credit balance. So when we received interest on capital, my current account balance will increase. So we write it on the credit side. Now this money is coming from appropriation account because Interest on drawings, interest on capital, interest partner's salary, and then share of profit will be given through appropriation account. So your correct journal entry out here is appropriation account is to be debited and X current account should be credited. So option B is your right answer. 17B. 18. Arnold is in partnership with Brandley. The financial period ends on 31st December. One of the terms of their partnership agreement is that interest is charged on drawings on a monthly basis at the rate of 5% per annum. Arnold made the following drawings during the year on the date specified. So these are the dates in which Arnold withdrew money from business, and these are the amount. They mention that we will charge interest of 5% but on monthly basis. Okay, very simple. Calculate the amount calculate the month and then amount for each drawings. What is the correct treatment for the interest on drawings in the appropriation account for the partnership? Okay, first let's calculate the amount, then we talk about the treatment. Okay, because they also need to find out the amount. So from March 31st we withdrew. So from March 31st to December 31st we have 9 months. Okay, and then from 30th June 30th to 31st December is 6 months. Okay, and then from 30th September 30th to 31st December is 3 months. Okay, and the last one is 31st December to 31st December, which is 0 months. Okay, so here let's calculate the interest. We have 6,000 as drawings. Interest rate is 5%, which is 5 divided by 100. Now once you get this amount, we'll multiply this with monthly basis. So 9 months out of 12 months. Okay, I hope you understood this. So amount is coming 225. Second one, the drawings is 10,000 and this is also 5%, and we need to calculate on a monthly basis, so 6 months out of 12 months. So the amount out here is 250. Okay, last one, drawings is 12,000 and 5% interest for 3 months out of 12 months. So this is 150, and last one is 0 months, so no interest. Okay, we do not charge any interest on that. So let's calculate the total amount, which is 625. So option C and D is cancelled, A and B. The correct treatment for drawings is, or interest on drawings is, when we prepare the appropriation account, we will add back interest on drawings to the profit for the year. So it will increase profit, and then from that amount we will start distributing that profit into the partners in form of interest on capital, salary, and share of profit. So right answer is 625 added to the profit for the year A. For 18, correct answer is A. 19. Which statement is correct in relation to the financial statement of limited company? Number A, debenture are presented as a part of total equity. Debenture is a loan and not equity, so is a long-term liability. Then dividend paid is shown in the statement of changes in equity. So when we prepare the statement of changes in equity, all the dividends paid should be subtracted from retained earnings. Okay. But if there's a proposed dividend, we will not write that at all. Like question C, proposed dividend reduce the balances of retained earnings. So we do not write proposed dividend, so it does not reduce the balance. Only the dividend paid should be recorded. And number D, the gain from revaluation of non-current asset is added to retained earning. So revaluation of non-current asset is a capital gain, so we'll write it under revaluation reserve. And retained earning was created out of profit for the year, so it is revenue reserve. Okay, so this is the capital reserve, this is the revenue reserve, so we do not write this amount or the gain out here in the retained earnings. So your correct answer out here is B. We show dividend in the statement of changes in equity. Correct answer 19B. And the last question for today. A company provided the following information about its equity: 150,000 shares of $1 each, $150,000. Share premium 75,000, general reserve 125,000, and the retained earning 25,000. The director proposed to issue bonus shares on the basis of 1 share for every 3 already held. First one is the bonus shares. Second one, following this, the director intend to make a right issue on the basis of 1 share for every 4 share held at a premium of 0.12 per share. Okay. Then they are asking you, what is the total equity of the company? Very simple question. We need to do this in 2 stages. First one, let's calculate how many shares company has. So 150,000 number of shares. So I have 150,000 shares. Each share value is $1. So divide that with 1. And then you will get the number of shares, okay, which is, so we have 150,000 shares. We issued bonus shares, and bonus ratio, they say, will give you 1 share for every 3 held from 150,000 shares. So it means if you have 50 shares, if you have 3 shares, will give you 1 shares. If you have 150 shares, will give you 50 shares. If you have 150,000 shares, will give you 50,000 shares. And we issue bonus shares always at par, that means at $1 each. Now, the total number of shares after issuing the bonus share is 200,000. Okay. Then comes the right shares. Okay, and the right shares proportion is, will give you 1 share for every 4 held. Now after issuing the bonus share, we have 200,000 shares. So if we cross multiply this into 1 divided by 4, we'll get another 50,000 shares. We need to multiply the value. Okay, bonus share is issued at $1 each. So the value of this is still 50,000. Right shares is issued at premium. So 50,000 into 1.20. 1 is the par value and the premium amount is 20. So total amount that we are receiving after issuing this at at premium is 60,000. Okay. So this is the value of new bonus share. This is the value of right shares. The question was not asking you how much is the value. The question was asking you what is the total equity of the company after issue, okay, after share issues. So remember that when we issue bonus shares, there is no inflow of cash. Okay, so whatever money that we have, same thing will be circulated. So we need 50,000 to give bonus shares, so we'll take amount from the share premium and put it into the share capital. That's it. So there's no inflow or outflow of fund. Okay, but whereas when we issue right shares, there is an inflow of money, inflow of fund. Okay, so here overall capital is increasing, or equity is increasing by only 60,000. So if we add all of this, 150,000 plus 75,000 plus 125,000 and 25,000, and add this new inflow of 60,000, this would be your new capital amount. Okay, 435,000. Now if you have not understood this, then let me prepare small account for your understanding. Okay, this is your shares. Okay, and this is premium, this is your general reserve, and this is your retained earnings. Okay, share is 150,000, then share premium is 75,000, then general reserve is 125,000, and your total equity is retained earning is 25,000. Okay, and just calculate the total out here. This is your opening balance before we issue shares, or let's write down balance BD. Okay, and then we issue bonus shares. Bonus shares, so we are issuing worth 50,000 bonus shares, so we added 50,000 here. We take this 50,000 from my share premium. Okay, no effect on total. Then we issue right shares, and right shares also we issue 50,000 right shares. So par value is 1, so in share premium we'll only write down the par value. So 50,000 into 1 will still give you 50,000. And in premium, the premium amount, so 50,000 shares into premium, which is 0.20, that will give you 10,000. So we'll 10,000, we'll write it here. Overall my 60,000 is adding up here. Now we'll calculate the final total, and the total on the share is 250,000, share premium, general reserve, retained earning, and the total is this. Okay, share premium balance is now 35,000, general reserve and retained earning remain as it is, and my new total equity is 435,000. Okay, I hope this makes sense. So your correct answer for question number 20 is 435,000 B. Which statement about ratios are correct? Number 1, ratios are affected by accounting policy. Ratios can be compared with the industrial average. Ratios generally ignore inflation, and ratio includes non-monetary items. So first one, ratio affected by the accounting policy, that is definitely true. If we change the accounting policy, then it will also have an effect on the profit or the value of the assets or liabilities in the business. So ultimately our ratio would get affected. Then ratio can be used to compare the data either with the previous performance of the company or with the other business in the similar industry. And then third one, ratio generally ignores inflation. Yes, it does not take into consideration time value of money. It will simply tell you what was the ratio 10 years back and what is the ratio now, or what is the ratio last year and what is the ratio this year now. Okay. And then the last one, ratio includes non-monetary items. Ratio does not include non-monetary items because it will include only the monetary value into consideration. How much asset business has, how much profit we made. So non-monetary item will not be included. So the correct answer for 21 is 1, 2 and 3, which is A. 22. A limited company achieved a return on capital employed 5% for the previous financial year. The following additional information is available. Equity 1 million, 10% debenture 200,000, finance cost 20,000 and tax 10%. What is the profit for the year of the company? So for this we need to calculate return on capital employed. So let's do that. Return on capital employed is very simple. So profit from operations, and this would be divided by capital employed and into 100. I'll just write down this one here, into 100, and it should give you equals to 5. Okay. Sorry, equals to does not come here, so I'll just write it here, and then this is 5. So let's replace this value. Profit from operation we don't know, so we'll just call it profit. Okay, and the capital employed is equity plus non-current liability. So 1 million plus 200,000, so 1,200,000, and then it will be multiplied by 100 equals to 5. So let's cross multiply this one. So when we do cross multiplication, 1,200,000 will be multiplied with 5 and then we'll divide by 100. So this is your profit from operation is equals to 5 into 1,200,000, and then this will be divided by 100. And the final step, let's calculate that. Profit from operations is 5 into 1,200,000 divided by 100, and we are getting 60,000. Profit from operation is 60,000, but company, they are asking us what is the profit for the year. So we need to subtract finance costs and taxations that was given to here. So this is your finance cost, which is 20,000. So minus 20,000, and then the tax, that is minus 10,000. Okay, and when we subtract this, which is 30,000 out here, this is my profit for the year. Okay, so correct answer for this question 22 is B. Next one, 23. A business rents machine for use in its factory. The rent cost of machine is 12,000. Each machine has a capacity to produce 60,000 units. The business provides the following informations. Number of units 90,000, 120,000. The total cost excluding rental cost of machinery 510,000, 600 and 60,000. What is the total fixed cost to produce 100,000 units? Okay, so let's analyze this one. We are producing 90,000 units and we paid 510,000, and this 510,000 includes both fixed cost and variable cost, but in this it does not include the machine rent, which is also another fixed cost. So first we calculate how much fixed cost is included in this, okay, and then add the rent of the machine to calculate the total fixed cost. And this is simple. Okay, first what we'll do is we will look at how much is our variance out here, okay, or how much is my variable cost included at this production. So 90,000 we are producing, and then 120,000 is now what we are produced. So if you look at here, the difference that we are getting is 30,000. So we make 30,000 units, and why I'm doing this is I want to calculate what is the difference in the cost as well. So cost difference is 510,000 divided minus 660,000. Now if I do that, then this will give me the cost of producing 30,000 units. Okay, so I was producing 90,000 units, now I produce 120,000, so extra unit I produced is 30,000. I was paying 510,000, now I am paying 660,000, so extra cost that I paid is 150,000. So the cost that changes along with the output is called variable cost. So for 30,000 I am paying 150,000. That means my variable cost for one unit would be 150,000 divided by 30,000, and that is $5. Okay, for one unit variable cost we are paying is $5. So my total variable cost for 90,000 unit will be 5 into 90, and that is getting 450,000. If this is my total variable cost, and I can easily calculate my fixed cost. Okay, so fixed cost is, if I subtract variable cost from the total cost, I'll get fixed cost. So total cost that I'm paying is 510,000. So my fixed cost is total cost minus variable cost. Fixed cost is 60,000. Okay. Now fixed cost does not change with the output, no matter what the level of output is, either 90,000 or 100,000 or 120,000. Okay. If I calculate in 120,000 unit as well, I'll get the same fixed cost. Let me just show you here. Okay, so total variable cost for 120,000 units is 5 is per unit, and then we are making 120,000 units. So total variable cost we paid is 600,000, and total cost we paid is 660,000. So total cost minus total variable cost will give you fixed cost. So my fixed cost out here is 60,000 again. Okay, now we already calculated the fixed cost included out here, but this fixed cost does not include the rent of the machine. Okay, and they say that the rent for the machine is 12,000, but each machine will produce only 60,000 units. So in order to produce 100,000 units, I need two machineries. So that means 24,000. So 60,000 is the fixed cost included here, and 20,000 for the machine. So altogether we paid 84,000. For answer 23 is B. Let's go to 24. A company sells a product for $12 per batch. The variable cost is $4 per batch. Fixed costs are observed based on the normal level of activity, which is 100 batches at $3 per batch. And we need to calculate what is the profit under marginal costing if company makes and sells 125 batches. So as per the marginal costing, we will have selling price. Okay, so selling price in this case is 12, and then we need to calculate variable cost. Variable cost in this question is given 4, and then we need to calculate fixed cost. Okay, fixed cost out here they said it would be observed for 100 batch $3 each. So 100 and $3 each. So total fixed cost that we are paying is this into this, which is 300. Okay, I hope you understood this. Now whenever we calculate profit using the marginal costing, we need to calculate contribution. Okay, and contribution can be calculated when subtracted variable cost from fixed cost. variable cost from selling price. So selling price minus variable cost will give you contribution, and this is contribution per unit because this is a selling price per unit and variable cost per unit. Okay, this is contribution per unit because it is the selling price per unit, variable cost per unit. So obviously contribution is also per unit, which is 8. Okay, I want to calculate my total contribution, and total contribution is total unit we are making is 125 batches. So contribution out here is $8 into 125 batches. That will give you $1,000. So in total contribution, if I subtract fixed cost, which is 300 we got, then the difference is our profit as per marginal costing. So selling price minus variable cost will give you contribution, and if you multiply that with the total output, then it will give you total contribution, and from that total contribution, when you subtract fixed cost, you will get profit. Okay, it is 700. Now you can also do something like this. We can also find out total selling price, total variable cost, and directly skip contribution per unit part and calculate total contribution directly. Okay, if I do that, then 12 is a selling price per unit per batch, and then we are making 125 batches, so total sales is 1500. Variable cost per unit per batch is 4, and we are making 125 batches, so 500. Selling price minus variable cost will give you contribution, and that is 1000 again. And in that 1000, if you subtract 300 fixed cost, then 700 is our profit. So for this question number 24, your correct answer is C, 700. Let's move on to the next question, 25. Which statement correctly compares the benefit of absorption and marginal costing? Let's look at that. Absorption costing, A, avoids the need to separate fixed cost and variable cost. Absolutely true. Okay, when we use absorption costing, we do not separate variable cost and fixed cost like marginal costing. We just take into consideration direct cost and overheads and calculate the production cost. So correct answer is A for the absorption costing. Let's see if that is also true for marginal costing. So in marginal costing, useful when there is limited factor affecting the production. Yes, when we did a question or problem in marginal costing, we learned that there is a one aspect which it will help us, that is limiting factors. For example, if we have less number of labor hour available, or if we have less material available to produce product, then marginal costing will help us to calculate what is the optimum utilization of those resources so that we can achieve maximum profit. Okay, if you remember that sum, I'll give example. Let's say you are producing product A, B and C, and now to produce all the unit for A, B and C, you required 1000 labor hours. But somehow this month we don't have 1000 labor hours, we have only 900 labor hours. So how we plan our production so that our profit is maximized? So that process is, or that's is called limiting factors or optimum utilization of limiting factors. Okay, and marginal costing will help us in that. So for 25, correct answer is A, so we don't need to consider B, C and D. 26. The following table shows details of production for a week. So this is budgeted production overhead 100,000, actual production overhead 80, expected production is 5,000 units, and over absorption of overhead is 10,000. Now before I solve this question, let's understand what is over absorption. Okay. So over absorption is when your budget is more than the actual expense or actual overhead. That is called over absorption. Now in this case, if you look at here, my budget is 100,000 and my actual production overhead is 80,000. So it is exceeding by 20,000. So my overhead absorption should be 20,000, but they are saying it is only 10,000. It means that the actual production output level is less than 5,000, because this 5,000 is the expected or the budgeted production output. So my actual output is less. So we need to calculate what is that actual output for this week. Okay. And this is very easy to calculate. So first let's calculate how much is my budgeted overheads. Okay. So budgeted overheads out here should be 90,000 and actual overhead is 80,000. In that case, when I subtract actual overhead from budgeted overhead, I will get overhead absorption or over absorption of overhead as 10,000, right? So let's do that here. So this is your budget. Budget should be 90,000, and in that, if we subtract actual of 80,000, then my over absorption should be of 10,000. Now this is the valid condition in that. Okay. There's a number of ways that you can do it, but I'll use the easiest method to calculate the unit. Okay. So if we are making 5,000 units and then we spend $100,000 or we plan to spend $100,000 to make it. So how many units we should make to spend $90,000? Okay, do the cross multiplication and you'll get your answer. Okay, so cross multiplication is, so x equals to 5,000 into 90,000 and this whole divided by 100,000. I'll write that number in equation now. And we are getting 4,500 units. So we have to produce 4,500 units in order to get 90,000 as my budgeted cost. And when I subtract that actual cost from the budgeted cost, I'll get the over absorption of 10,000. So your production for this week is 4,500 units. Answer for question 26 is C. Okay, 27. A business has produced the following budgets. Revenue 700,000, contribution 560,000, fixed production cost 350,000 and fixed non-production cost to 20,000. What is break-even revenue sales? Okay, so in order to calculate break-even revenue sales, first we need to calculate break-even point, and break-even point can be calculated with this formula, which is fixed cost divided by contribution per unit. Now in this question we don't have contribution per unit, so there are two ways that you can solve this. Let's use the easy method first and then we'll do the assumption method second. Okay, so first let's calculate the fixed cost. Fixed cost is the total fixed cost. We have 350,000 plus 20,000, that will give you 370,000 is my total fixed cost. And let's divide this with the total contribution. Normally we need contribution per unit, but that information is not available to us, so we'll use total contribution of 560,000. Okay, now this will give you a number. Okay, and that number is a break-even unit, and we'll multiply that with the revenue to calculate the break-even revenue. So my BEP out here is 370,000 divided by 560,000 will get a number, and let's multiply this number with the revenue, which is 700,000. Let's write down this somewhere here, and then we'll write down BEP sales. And BEP sales is, sorry about that, BEP sales is contribution break-even units into total revenue, and then we get 462,500. Let's try the next method, which is the assumption method. Okay, let's assume that we produced and sold units as 1000 units. You can assume any number. I'm just doing this for the ease of calculation. Okay, let's calculate sales per unit. Okay, sales per unit, we are making total revenue of 700,000, and we assume we made and sold 1000 units. So 700,000 divided by 1000 will give you sales per unit. Okay, so that is 700. So now let's calculate contribution per unit. And the total contribution is 560,000 divided by total unit produced and sold is 1000. So we'll take that and calculate contribution per unit. So contribution per unit is 560. So let's calculate BEP, which is total fixed cost 370,000. Okay, 370,000 is 350 plus 20 divided by 560, which is the contribution per unit, and this is my break-even unit. So in order to calculate break-even sales, we'll multiply this unit with the selling price per unit, and BEP sales is unit, break-even unit into selling price, and that will give you 462,500, same as the first one. So whichever is easier for you to understand, you can do that. So for 27, correct answer is D. Question 28. How is the margin of safety calculated? Okay, margin of safety is a difference between the actual sales minus break-even sales. So here, total sales unit minus break-even sales unit is your margin of safety. Okay, let's go to 29. A business has a contribution to sales ratio of 40%. The following information is available. Sales revenue 100,000, fixed cost 30,000, and profit 10,000. So it is predicted that sales revenue will increase by 20% next year. Total fixed cost will remain unchanged. What will be the increase in the profit? We can also use the contribution to sales ratio to calculate the contribution first, and then from there we subtract the fixed cost to calculate the profit, and we'll get the same profit as we know. Okay, but there is an alternative to that. I'll show you both the ways. Contribution to sales is contribution divided by sales will give you 40. Contribution divided by sales should give you equals to 40. Now contribution we don't know, so we'll just name it X, and the sales amount is given 100,000. Okay, this is your 40%, and this is equals to 40%. Now let's do the cross multiplication. Okay, so X, which is a contribution, I'll just write down contribution instead of write down X. Contribution is equals to 40% of 100,000. Okay, so 100,000 into 40%. Now if I calculate this number, then I'll get 40. Okay, this is my contribution. How do I calculate contribution? Selling price minus variable cost will give you contribution. Okay, selling price we already know is 100,000. Contribution we just calculate, which is 40,000. That means my variable cost should be 60,000. Okay, I calculated that this way. Other way we can calculate the contribution or the variable cost is, just look at this table out here. Sales or the revenue is 100,000. Now in this 100,000 I need to subtract fixed cost and variable cost to calculate profit. Fixed cost is given 30,000. Okay, how much more should I subtract from here so that my profit becomes 10,000? Okay, so 100,000, and if I subtract 60,000 more, that will be total 90,000 subtracted from 100,000. So I'll get profit of 10,000. So this is 60,000 here. Now once we calculate the variable cost, real solution begins now. So they are saying that revenue will increase by 20%. Okay, so if this is increased by 20%, then the new revenue would be 20% of this is, what happened, into 20%, so which is 20,000. So the new revenue would be 120,000. As question said, fixed cost will remain unchanged. So fixed cost will still be 30,000 here, but variable cost changes because we are selling more units. We need to produce more, so variable cost obviously changes, and it will also change by exactly same proportion as the sales because we need to produce exactly 20% more. So 20% of 60,000 is 12,000. So when you add, total would be 72,000. Okay, so I have a fixed cost, I have a variable cost out here. If I subtract these two costs from the revenue, then I'll get the profit. So revenue minus fixed cost minus variable cost, and the profit is 18,000. But remember, this is not the answer. Question was asking you what will be the increase in profit. So last time we have profit of 10,000, now it is 18,000, so it will increase by 8. So right answer for 29 is A. Okay, last question. The actual output of business is lower than forecast. Which costs are usually the same as forecast? So if your actual output decreased, then the forecast. Let's say we are planning to produce 100 units, we made only 50 or 70 units. So which cost will remain same out here? One is fixed cost per unit. Fixed cost per unit will not remain same, it will change when the output changes. Total fixed cost will remain same. Total variable cost will not remain same because it will change as per the output, but the variable cost per unit. Understood this? Then the right answer is 2 and 4, which is option C. Let me show it to you how it is. Okay, so let's say my total fixed cost is 500. Okay, to produce unit as 100. Now even if I produced only 80 units, my total fixed cost will still be 500. But my fixed cost per unit will change. Let's see. So total fixed cost is 500 divided by total output. So in this case this is 5, but out here when the output decreases, the fixed cost changes. Okay, and the variable cost, we know that variable cost per unit will remain same no matter what. So if my variable cost is, let's say $2 per unit, if I make 100 unit or 80 unit, variable cost per unit will remain same. Okay, let me just denote it here: total fixed cost and variable cost per unit. But the total variable cost will change. Okay, because it is as per the output. So this is 200 out here and this is 160 out here. So right answer for question number 30 is 2 and 4, which is C. Okay, with this we come to the end of this paper. We will solve more paper from 2025 May June, paper 1, 2 and 1, 3. Stay tuned for that. Till then, happy learning. Have a nice day.